Good afternoon. Welcome to our End of Q3 economic research briefing. My name is Jason Prees, CEO of Prees Capital, and the objective today is simple: translate complex market signals into a positioning plan you can execute with conviction. We'll start with a clean review of index and sector performance, move through the macro engine, employment, inflation and wages, growth and debt dynamics, housing, manufacturing and services, the dollar, and the consumer. Then connect that to the Treasury curve, credit spreads, and corporate yields. We'll wrap with the trends impacting markets, screen winners and losers, the Fed's policy shift, volatility complacency, index concentration, and the growing role of alternatives before I lay out the Prees perspective for Q4 positioning. The goal is not to recite numbers, it's to interpret what they mean for risk, duration, style, and hedging so you can defend decisions in front of clients. Let's get to work. This section frames where returns actually came from and whether leadership is broadening. The sequencing matters. We look at major index performance, sectors, asset class tables across multiple periods, then diversified portfolio behavior and equity style factors. If the quarter rewarded quality balance sheets and free cash flow compounding while penalizing weak balance sheets, that guides how we size our core versus satellites. If breadth improved while policy eased, we'll be comfortable expanding beyond the top-heavy names because dispersion will remain high. The analytical question is always the same. Are we being paid to take risk in the right parts of the market, and is that payment durable if growth slows modestly while inflation normalizes? Today's data says yes, if you stay disciplined on quality and duration. Major indices posted positive trailing returns into quarter end, with leadership still anchored in U.S. growth benchmarks and EM cyclicals re-engaging as the dollar's impulse cooled. For allocators, that argues for a core plus approach: maintain a durable U.S. large cap growth core, then express tactical tilts in EM or small to mid only where revisions and currency trends validate. We don't chase high beta, we buy compounding where capital discipline is intact and end demand is visible. If you've been overweight cash, the math is shifting. As policy eases, the opportunity cost of staying on the sidelines rises. Rebalance methodically on weakness rather than chasing strength. The continuation slide confirms dispersion. Leadership clusters in technology-heavy indices, while value-tilted baskets lag on a relative basis. The takeaway is not ignore value. It's that cash flow visibility and balance sheet strength are still being repriced upward. Use this dispersion. Harvest gains where multiple expansion outran fundamentals, rotate proceeds into names with improving estimate breadth and underappreciated margin durability. Think like an underwriter, not a momentum tourist. Sector scorecards show technology leadership, with defensives mixed and materials more sensitive to global goods softness. We translate this into portfolio design by pairing a structural overweight to quality tech and semi-cap equipment with selective financials where NIM pressure is easing and fee income is resilient. Keep healthcare tactical. Policy headlines can cap multiples even when fundamentals are fine. The question to ask on each sector sleeve: where is pricing power intact? And where do balance sheets buy time if growth cools? The long horizon tables reinforce a core truth. Equities dominate over time, but path matters. Clients don't live in annualized space, they live in drawdowns. That's why we emphasize quality in the core and keep a persistent sleeve in diversifiers that compress portfolio volatility without sacrificing too much carry. Use these tables to calibrate expectations. Long-run equity premia remain intact, yet the mix of growth versus value and domestic versus international is what determines the ride. We want durable compounding and tolerable drawdowns, not heroic single-period wins. Quarter-by-quarter boxes show a risk-on with policy support cadence punctuated by brief risk-off pockets. That pattern favors buying dips in core exposures rather than chasing late-stage momentum. If we see repeated green and growth-heavy boxes whenever rates ease, that's your tell to keep the quality growth core funded and to avoid starved positions in hopes of a deep rotation that never fully arrives. Tactical, not binary. Diversified blends performed as designed, lower volatility than pure equity, steadier return progression than long duration. The lesson is to use each sleeve for its job. Equities for long-term growth, investment-grade credit for carry, long treasuries as a tactical hedge, and alternatives for convexity. If your blend underdelivered versus its risk, the fix is rarely more beta. It's better underwriting of quality, more intentional duration placement, and a cleaner hedging sleeve. Style tells the macro story. Growth outperformed as discount rates eased and secular productivity themes, AI, cloud, and automation drove revisions. Small-cap participation is improving but remains selective given refinancing calendars. Implementation of large-cap quality growth as the anchor. Mid-cap compounders as beta-efficient diversifiers. Small-cap as a paced rotation tied to balance sheet strength and positive estimate breadth. Valuations are elevated versus long averages but rational versus real rates and margin resilience. High-quality cash flows deserve a premium in a world of moderating inflation and easing policy. The mistake is to sell purely on multiple without assessing durability of earnings and reinvestment runway. Our framework pays up for visibility. Demand a discount where leverage, pricing power, or unit growth is questionable. Now the engine room. Inflation and wages, employment, leading indicators, GDP and debt, trade, housing, manufacturing and services, dollar strength, and the consumer. The narrative for Q4 is defined by inflation cooling from its peaks, labor is softening without breaking, services momentum is rebuilding, housing is stabilizing as mortgage rates edge down, and consumers remain selective but engaged. That is a constructive mix for quality risk and measured duration. Inflation has moderated while wage growth is normalizing. For portfolios, lower real rate pressure lifts the present value of durable cash flows and restores the hedging utility of duration. The key is pace. If inflation glides rather than drops, we stay in a carry-friendly regime, good for quality growth and for intermediate investment grade, without the need to swing for home runs in the longest duration. PCE versus wage growth is converging lower as the lines are crossing down. Payrolls are cooling and unemployment has drifted higher, consistent with a soft landing narrative that alleviates wage price pressure while preserving demand. From an equity implication, multiples can hold if earnings breadth continues to improve. On the credit side, we expect carry to grind higher but be cautious. The weakest balance sheets still face refinancing risk, so we must underwrite carefully. Leading gauges are stabilizing from contractionary levels. That supports a view of below trend but positive growth into Q4. We tilt toward businesses with self-help levers such as pricing, productivity, and cash discipline rather than those dependent on generous capital markets. In fixed income, it favors investment grade over the riskiest high-yield tiers. Growth has moderated, while public debt continues to climb. For markets, the immediate signal is about term premium. Persistent issuance can pressure the long end even as the Fed eases. That's why our duration lives mostly in the 3 to 7 year belly. Better roll down, less exposure to adverse long end moves while we keep long duration as a tactical hedge rather than a core income engine. Trade dynamics reflect resilient domestic demand and a still strong services surplus, while goods flows remain sensitive to global growth. For equities, multinationals with diversified revenue and pricing power remain advantaged. For EM tilts, favor countries with credible policy and improving external balances. Housing shows tentative stabilization as mortgage rates ease from peaks. New home sales and selected builder activity are improving on the margin. Our implementation focuses on building product leaders with strong balance sheets and advantaged distribution. Caution with levered REITs still facing elevated funding costs. In credit, emphasize quality and RESI-linked exposures. Inventory remains tight in many regions, supporting price levels even as transactions normalize. The near-term opportunity is surgical, not thematic. Own the operators with cost control and backlog visibility. Avoid balance sheets reliant on cheap capital that's gone. Manufacturing is subdued while services have re-accelerated into expansion. That mix is equity-friendly and credit-constructive so long as services strength persists. Our sector tilts favor services-heavy platforms with pricing power and operating leverage. Keep a watch list of cyclicals for when goods prints inflect. Dollar strength eased off highs, supporting EM and US multinationals translation effects. If DXY stays range-bound to softer, we can own selective EM beta and global cyclicals, hedged where currency volatility remains elevated. Consumers are selective but still spending, with services outpacing goods. Watch real incomes and delinquency trends. If they remain contained, earnings breadth holds. We favor platforms with recurring revenue and pricing power over pure volume stories. So this section will connect policy to pricing across 4 key areas: front-end rates, belly dynamics, term premium, and credit spreads. The message into Q4. Easier policy restores duration's hedging role. Carry remains attractive in investment grade. Underwriting still matters in high yield. We'll bias duration to the belly and keep a tactical long duration hedge. Front-end yields are stepping down as cuts begin. Spreads are steady to tighter where quality is clear. That's a carry-friendly regime. We harvest investment-grade carry in intermediate maturities and stay selective in high yield, prioritizing issuers with self-funded growth and manageable maturities through 2026 to 2027. The curve remains inverted but is flattening via front-end declines. Term premium at the long end can reappear with supply, so we prefer 3 to 7 year for roll-down and convexity, using 10s/30s as a hedge rather than income engines. As cash yields fall, ladder into investment grade to keep portfolio income durable without betting the farm on ultra-longs. Corporate yields remain attractive versus history even after spreads grind. The trick is avoiding false economy. Don't stretch for yield in credits that need the market's kindness. Focus on balance sheets with covenant headroom, consistent cash generation, and pricing power. Pair investment-grade core with a controlled high-yield sleeve to lift income while keeping left-tail risk in check. The next set of slides are what I call the charts of the moment, basically depicting trends that are impacting markets and investments. Winners cluster around semiconductors, software monetization, and select cyclicals. Losers lean into policy-sensitive healthcare, levered consumer, and idiosyncratic execution misses. Use this dispersion to fund upgrades, trim rallies where thesis drifted, add to durable growers with clear catalysts. Keep a catalyst calendar. Dispersion is our friend if we stay disciplined. The policy shift from holding to cutting is the fulcrum for Q4. Easing supports duration and quality growth, but it's not a rescue. Growth must cooperate. Position for a gentle descent in real rates, belly duration, quality equities, and a measured gold sleeve as convexity against policy or geopolitical surprises. Low headline volatility can mask single name and sector dispersion. We respect calm, but we don't underhedge. Keep optionality where portfolios are concentrated, and use long duration as a complementary hedge if growth disappoints. Hedging should be systematic, not episodic. Concentration remains elevated. That is both a strength, leadership is profitable, and a vulnerability. Our answer: own the leaders we believe can keep compounding, but broaden exposure into mid-cap compounders and service-oriented cyclicals where revision breadth is improving. Diversification is a risk tool, not a performance tax. Alternatives, particularly gold and select real asset exposures, regained momentum as investors sought convexity that doesn't require a crash to pay. We treat gold as an all-weather hedge during policy transitions, and we use real asset exposures sparingly where cash flows are visible and balance sheets conservative. To close, Q3 confirmed a transition toward easier policy, a services-led expansion, cooling labor without collapse, and risk assets that reward quality balance sheets and credible growth. Our stance into Q4 leads us to keep a quality growth core, add cyclical exposure where revisions validate, hold intermediate maturity investment grade for carry, keep long duration as a hedge, and maintain a measured allocation to gold for convexity. Use this deck with clients. It's built to help you communicate clearly and defend decisions. On behalf of our team here in Myrtle Beach, thank you for your continued trust and partnership. I'm Jason Pries, and this is the Pries Perspective for the end of Q3 2025 Economic Research Briefing.